Okay, so everyone should see that up on the screen. So yeah, thank you, Jana, and thanks, Adam, also for the introduction. It's great meeting Adam and many of the great presenters that we've had in the show so far. So it's a pleasure to be part of a great group of educators. And today, what I would like to add to the mix is to talk a little bit about developing scans. Of course, in these very interesting and turbulent markets, it's very important that we know what we're looking for with so many things out there to distract us, so much news, so many different stocks to follow, and I found that the crucial keeps trading effective and interesting is the ability to be able to scan for exactly what I'm looking for, and but developing scans isn't always an easy process. I've found that if you want to think about how many technical indicators there's 220 plus technical indicators out there, and for each of the indicators there's tens if not hundreds of variations of variables that you can use. And on top of that, then there's all the fundamentals, there's all the sectors, and then there's all the market conditions. And I remember doing the math. I think it was, gosh, about seven, 8 years ago. I sat there one night when I was really bored, and I figured out what all the possible combinations of all these factors, all these variables added up to. It was something in the hundreds of millions of different possible combinations. And I thought, well, what chance do people have with figuring out what they're looking for with so many options? So what I want to do today is start taking you into the mindset of how we go about developing scans and the different factors that go into that, and then I'm going to talk about where we're currently at in the market and what scans and what strategies we're finding best going into the months of May and onwards. Of course, just a standard disclaimer up on the screen. So for those of you who don't know Acorn, I think there's probably a lot of people we've met in our travels, but for those of you who haven't, Acorn was founded back in 2007 by myself and a small group of traders. We had shifted from the fundamentals, which is my background, and focus more on the technicals, simply because we saw so much of the market changing. This was key to us predicting the crash of 2008, as well as the fall in 2010, and some key warning signs, of course, this year. But what I always like to do just before as we get going is to get an idea of the type of investors we have in the group. It's always a bit of a different, sometimes it's a lot of day traders, sometimes a lot of option traders. But for those in the room, if you want to share that with us, I will try and make sure we touch on some of the key areas that maybe the audience is going to be interested in when we start getting into the live slides. The important thing that is that no matter what type of trader you are, these technical analysis, it plays a critical role. And when people ask me what type of trader I am, I'm mostly a day trader and swing trader, but I prefer the term a target trader. So when I buy and sell a stock, it's because it meets the pattern that I'm looking for. And most generally the way I trade is by simply looking for entry and exit targets that I can set up well before the stock is even bought, and whether that takes an hour for the stock to hit the proper target, or whether it takes a day, or whether it's a week, what I'm interested in is that target-based equation. So the second question I'll ask you before we get into the theory here is, how do most people make their decisions? Does most people here in the room already use scans, or are there other factors that you're currently predominantly using? Of course, what I've got up on the screen here is I find a lot of traders are still making their decisions from news, friends, brokers, advisors, or even things they're familiar with. That's a photo of Vancouver. That's actually our office, I think, right about here, where I'm sitting at the moment. So that's the type of usually what people are sticking to, or all of the above. Thanks, Valerie. Yeah, because I mean, often without having targeted scans, it's very difficult to know what to go for. I talk to fundamentalists and they say, well, I know what I know what a good company looks like, but so I find a good company. It might be Apple, and I say, hey, Apple's a great stock, but maybe the timing's wrong. And so they wait and they wait and they wait, and by the time the stock's dropped to the price that they'd be willing to buy it, the fundamentals have all changed. So all that research they did before now is wasted time. So what we want to try and do is get into the habit of getting away from things that are emotionally based, things that can constantly change, because these often lead to us failing to limit losses. We average down, we buy into emotion, all the things that people have experienced before. Sell on pullbacks, take too much risk, because we're constantly justifying how good our idea is, because it's not necessarily quantified. It's not an exact strategy where there is precise entry, exits, and stops based on trading strategy that's been proven to work. And I think that's why a lot of people lose money, is that they constantly backfill their losers and feel like when something goes bad, it will eventually go up because the market owes it to them. And of course, we know that's not true. So let's talk more about timing then. So we can have good ideas. We can have thoughts on the market or concepts about stocks, but we really need, even if we're going to do that, and we want to have that type of foundation, how do we then time those ideas? And that's the critical thing. And I'm going to be talking about a couple of strategies. In specific, we're going to be talking about flags later today. So how do you do your timing? So what exactly is your strategy? If you could take a pen and essentially draw the perfect chart of what you want to see, what would that look like? And if you were to write down what those criterias would be, or what would those be that would confirm it? What is your shopping list? And I use this example every time, no matter what topic we're speaking on. A shopping list is important no matter what strategy you trade, just like buying a car. You know whether you need a 4-door or a 2-door sports car, or whether you need a truck, or maybe a motorbike. It depends on what you're looking for, how much you're willing to spend. And without knowing what that shopping list is, it's almost impossible to be able to get consistent results. And this is why the people that win the lottery get really wealthy very quickly and statistically lose it all within 2 years, because they've had a big win, but they have no way of replicating it. They haven't developed a skill set to continue generating money. And we need to have these variables of knowing what our exact methods of knowing when to get in and when to get out, how to manage risk, and these need to be tested over thousands of trades, so that when you implement a strategy, if you have a couple that go bad, it's okay, that you don't need to change it because it's within the strategy. So let's talk about the ingredients that go into a scan. So what we've got here is the 4 key ingredients that we start out with to go into building an idea that we can search for. So let's start with an idea. Let's say that we're looking at the fact that we've and may have rallied today, but we think that some stocks are beginning their downward descent. So let's say that that's the idea that we want to come out with. The second way we could start building out this idea is think, well, what conditions would be true if this idea was actually happening. So we might say, okay, well, if the market is at a false, excuse me, a false rally, and stocks are beginning their downward descent, what conditions may we look for? Well, we might look for stocks that are in the weak sector by going through a sector watch list and looking for what sectors are starting to fail and which are strong. We can look at what stocks have high P/E ratios and price to book ratios. And if these same stocks which have these very high P/E ratios, meaning that they're expected to have very good earnings and increasingly exponential earnings over the years to come, wouldn't it be strange if we also found that those same stocks that are the golden childs of the speculators had their own insiders and institutions selling? So we start building kind of conditions that just wouldn't seem right to be present if the stock was truly going to go up another 20% in this strong market rally. And then we add our triggers and indicators. So what we're building basically is a combination here of ideas and timing mechanisms where we can go in and say, and this is just an example, but we could go in and say then a trigger is, let's say that the market did go up 2% today. We could then add to that to say, well, let's search for stocks that in fact went down, either went up less than 2% or went down. And at the same time, broke key support. So we're basically looking at, in a strong market, the salmon that swam the opposite direction, if that makes sense. And at the same time, broke support that should have held it up even after that downward movement. So with all of these types of kind of, these things tell the story. And then we get into the indicators that help us with the timing. So now we know what type of story we're looking for. Now we can go to the indicators and start knowing what type of questions we want to ask. So we might be looking for an increase in the volume as the stock drops. Looking for a negative momentum indicator, such as a MACD. We can look, and then in markets such as May, June, July, where the volatility, where things can predominantly start going a little more sideways, one of the things we definitely want to make sure that we've got present is a high level of movement within the stock. So we can look for high ADX value above 25 to indicate that, yes, we've got a strong move down, we've got negative MACD, high ADX, strong movement. And so now we've basically got an idea that we can build out and then scan for and find stocks that then meet this criteria. Now, this should give us a basket of stocks that now could potentially have the timing bang on, where the timing could be right. And now if we want to spend our time researching what the stock is, who runs it, if you want to now apply your own analysis, at least you're applying analysis to stocks where the timing is right. So then you can action trades that day or within the next couple of days. Okay, so this is basically the first step that we go through when developing a scan. Now let's take it. Now, excuse me. I'll have a look at the question. ADX. ADX is an indicator which is often coupled with directional movement, and what it's a non-directional indicator. ADX. ADX on its own simply indicates whether the stock is lifeless or whether it has a high degree of movement within it, and is often found to kind of go between, well, levels as low as 0, but more typically from 10 to upwards of 30, 40, 50, 60. And the higher the level is, the more movement in the stock. So over 25 generally indicates the stock has enough movement to make a trade be able to go somewhere. Okay. Now, once we have an idea, let's flesh this out a little bit more. Once we have an idea, this then becomes kind of the overall checklist that prefaces which ideas we use and what type of scans we want to run. So this is the checklist I use for developing all strategies or running all strategies. The first question that I'll ask when I open up my trading window in the beginning of the week or the day is firstly, is the stock market bullish or bearish? Now that's a very subjective question because that really depends on which one of those four things people are listening to that day. Which BNN presenter, which newspaper they're reading, which friend is in their ear, what newsletter you're getting. It can be very subjective. So rather than ask, is it bullish or bearish, what I prefer to ask is the market at resistance or support? Is it at resistance or support? Now, if we are at resistance and momentum is present, then we might look for breakout strategies. If we are at resistance and momentum is weakening and volume is dropping, then we might look for reversal strategies. And the flip side on the bottom, if we are at support, then we might, the downside momentum is weakening, we might look for reversals, double bottoms, triple bottoms, falling wedges. We'll talk about those in a moment. Whereas if we are at support and momentum is increasing to the downside, then we will look for breakout strategies to the downside, such as descending triangles, rising wedges, things like that that would complement downside breaks. So once we've kind of had a gauged the market through, not through guesswork, but through drawing on the trend lines and support and resistance, we can then ask which sector is the most bullish or bearish, and then go through and look at those sector spiders. And this will allow us to kind of funnel down a little further to where the hot stocks may be. And then, as I mentioned, run the appropriate scan based on what we've discovered that could find stocks that give that idea backbone. So let's we can go and have a look at some of the charts to show you how this approach works here in a moment. But the next question we then ask is the stock approaching smart money support or resistance? Is the move confirmed using price action and supporting patterns? Do indicators confirm, and is there a special ingredient? So there was I saw there was a mention of what the Goldman Sachs knows this, and does the computer do it all? If we're talking about high frequency trading, I'm not sure exactly what the question was, but if we're talking about high frequency trading, this is exactly where this now starts to play into this. So the reason why scanning for particular criteria can work extremely well is that as we start to flesh out this idea, we start to see the importance of the smart money's presence in the scanning and strategies. So let's take a step forward here for a moment and go over to a live chart. So for example, if we were to look at the S&P 500 currently, let's zoom in, and I'll just go to a fresh page. So if we were to look at the market currently and apply this type of approach of what we may want to scan for, what do we see here? We see that we've got rising bottoms, always drawing left to right. We have a growing trend line. If we look at the opening range for the month of May, you'll see that the key support and resistance levels for May is between 1880 and 1890. That was the range for the first day of the month. It tells us very, very important levels that if the market breaks above or below can give us an indication of where we're going. Right now, however, we're just really oscillating back and forth. So are we at support or resistance currently? Right now we're at resistance. And if we take a look at one of the indicators I use a lot, which is money flow, we can look at how the money flow is moving as we approach this resistance level. And right now you can see that's consolidating as well. We're getting lower highs, higher lows. We're really just kind of moving into a bit of a consolidation pattern. But if we were to break higher than this 18%, and we were to break 1890 or start to approach 1890, this could be the ideal time to look for breakout formations, to look for flag formations, to look for basically bullish strategies. And then where will our next resistance point become? Our next key resistance, and I believe that we could quite likely continue to rally until the third Friday of May, being options expiration. So next Friday, somewhere up into this 1910 to 1900 area, and that's where I believe we'll have the next reversal, because that's where we next hit key resistance points. So it basically then gives us a window, and the way I would trade is then look at these types of breakout strategies for the next week leading up into those areas. So let's go back to the chart and look at the type of, we'll get into a lot more live charts later on. Okay, here we go. So the beauty of having kind of a non-subjective checklist is that it won't always be right. But I read in a book once, it's not about being right. It's not about, your main objective is not about trying to be right every time. Your main objective, firstly, is to conserve capital, but just in terms of strategy, your main objective is to trade well. And to trade well, it means having a discipline and having rules that you can stick to every single time. That takes a lot of emotion out of it, because you're never having to make every time you make the decision, you're not having to go through all of that work every single time. You're simply following a rule set. Just like when I drive to work. So I take a shortcut to work, which takes me down a back alley behind the restaurants in Vancouver. And usually saves me about 5 minutes a day. But a few weeks ago, I took that back alley. I ran into a garbage truck and ended up stuck behind it for about 15 minutes. And I remember thinking, geez, I'll never take this back alley again. And I immediately found myself applying my trading rules to that comment and thinking, well, that would be silly, because I would have missed all of the other times that I've saved myself 5 minutes on the way to work just because of that one time it didn't work out. But people do that in trading all the time. They constantly change the way they make decisions based on an experience by experience process. So what we're trying to do here is remove that those constantly changing variables and put in a set of rules that we can scan for. And once we do that, we can essentially go through every stock in the market with these scans and find a high quality batch, high probability batch of positions that are that meet these criteria. And for each strategy we run, we can usually be finished within about 20 minutes to have the positions that we're looking to trade for the next day with their entry and exit points. Now, the types of patterns that we scan for, or that are common, they're probably things that we're all familiar with. We've got double tops, double bottoms, head and shoulders, inverted head and shoulders. All these different patterns have different probabilities of success, profitability, and so forth. There's fallen angels, which are momentum trades, great in the winter months, not so good in the summer months. Downward channels, which are the type of things, oscillating patterns that seem to work very, very well in the summer. And each of these different patterns is going to give us a different type of level of success. So coming into talking about some of where we're at now in the market, given that we are in a market that there isn't a high degree of, in a lot of stocks anyway, a high degree of movement, what we want to look for are positions, in my opinion, that have a high degree of probability of substantial moves. So stocks that have a lot of strength coming in behind them. So some of the patterns that we are focusing on at the moment are pennant formations and flags. Have most people here traded flags or pennants before? Yes or no? Okay. So basically the idea behind these trades is a flag is typically when you get a very strong upward movement in a stock, a big burst of movement in the stock, which then kind of consolidates. And then however much it rallied before, it will then rally a second time. So flags can be especially interesting when markets aren't, in general, very volatile, or I should say aren't trending in one direction for too long, because you'll find that a lot of stocks that you'll trade might go up 3 or 4% and then go straight back down. And so they don't give a lot of movement between the levels that they bounce between. The beauty about flags is that by definition, a flag that we will look for generally goes up at least 10, 20, 30% in its first leg of its journey. So it's a stock with its own personality outside of the market. It's its own economy. So whatever the market's doing, this is kind of a special situation where it's got its own characteristics. Let's try and get to the next slide here. Okay, so once we've got the patterns down, what we then want to then go into scanning for is then looking at the time frames. So this is kind of one of the final checkpoints before we then go into indicators. Once we've got our idea, once we've assessed the market conditions, then we can actually go into looking at the time frames, which is, do we have time frames confirming the type of action that we see? Do we have, are we approaching resistance on the hourly time frame? Do we have a bearish pattern there as well, if we say swing trading? Do we see hourly, weekly, and daily all confirming what we think is going on? And if so, this increases the probability even further. And this is the final checkpoint, is indicators. And this is usually the opposite way around for a lot of traders that I've worked with over the years. Usually I find that a lot of traders are looking at indicators first to pick their stock. But the problem with indicators is that indicators they're very sexy because they give us an answer. Is the MACD up or down? But unless we know the question we're asking, indicators can actually give us completely incorrect or misleading answers. So we need to know what we're asking the indicator. So let me give you an example. Bollinger Bands. I'm sure everybody here has used Bollinger Bands. So with Bollinger Bands, they essentially tell us where the river of the stock is. You know, where does the stock spend most of its time? And if we look inside these bands, statistically, I think 90, 95, 96% of a lot of its movement is behind, in between these bands. Now, some traders look at buying a stock or shorting a stock when you get a squeeze of these bands. So another way to use these bands is when looking at when it hugs the band. Whereas the way that we a lot of the time use Bollingers is looking for when it goes outside the bands, because these are the extreme movements. Now, if you are let's say that you're the type of trader that looks for double tops and double bottoms. If you're that type of trader, then one of the things that you would look for is if the market is at resistance and the momentum is dropping, you might scan for stocks that are outside of their upper Bollinger Band and are also at this type of smart level resistance zone, a smart money resistance zone. So where the stock has rallied up, come outside the band, and at the same time is hitting a critical level of resistance that's previously shown a sharp drop. That would be how you would develop, for example, one scan, looking at a basic scan for a double top if you felt the market was at resistance. Now, on the other hand, where this can become sticky, where our traders can make mistakes, is if you are trading, for example, a flag, you actually use the Bollinger in a bit of a different way. So in this situation, we're looking for the stock to shoot down. We're looking for a bearish trade. Now let's switch to a flag, and let me show you where people can get confused here and how this indicator is used in the same way but for a different direction. So I'm going to go over to one of the trades we picked recently, BIOF. And this is essentially what a flag looks like. A flag is where you get this type of explosive movement. You can see it's actually done it a few times here. So this is essentially what a flag is. It's where you get an explosive movement up, in this case from $2.10 to a high of $4.10. And what will generally happen with a move like this, if it meets certain criteria, is it will then start to consolidate before then breaking and moving a very similar amount to how much it first moved. And so what you do here, just a very basic lesson in flags, is when you see a dramatic movement up, we find what was the trend line or horizontal level that it broke, so we draw that on. We then check, I'll just add the volume on, excuse me. We then check, did it break on substantial volume? Which this did. You can see the volume went from 28,000 shares to 9.27 million shares. So did it break on volume? Did it break a key resistance level? And if those two criteria have occurred, those are two of the first criteria that then confirms that it is a flag. But now let's add on one more thing, which is the Bollinger. And what we want to do is we want to use a Bollinger with a standard deviation of 2 on the upper, 2 on the lower, over a 20-day time period. And we then add that to the chart. I'll make that green for Acorn, or green for money. That's probably a better one. There we go, green for profits. So we've got the Bollinger Bands on now. So you'll remember that in the example where we're looking for a double top, the Bollinger Band was a characteristic that told us that the stock was at an extreme level outside of its river where it had no business being, and should therefore have a good probability of going back down. And the reason we feel it should go back down a lot is because it's at a smart money sell zone, a strong resistance level. Now in this situation, we're using the same ingredient, being the Bollinger, but in here we're using it as a characteristic of a stock that we feel is going to go much higher. Because how we're using it in this recipe is we're not using it to predict what the stock's going to do tomorrow, but we're using it to identify the flagpole. We're using it to identify that the stock has had an incredibly dramatic movement that is well outside of where it's normally able to move, as a predicator of where it's about to consolidate next. So same indicator, but complete different usage. That's why it's very important to know what your what kind of recipe, so to speak, you're cooking with. Okay, so what now happens is the stock will now consolidate. And it will consolidate typically in either a downward channel, it can consolidate in a pennant, and very few times I've maybe seen it go sideways, but not often. We're mostly looking for channel or the pennant. And as you can see, yes, the volume will drop off. The volume will drop off because this is a consolidation period where basically that big movement takes a break before the second move. The trick is to firstly now identify how much that move is likely to be. So we'll go on to a logarithmic graph for that, because we should always use logarithmic graphs when measuring the size of candles, because the scale of the movement changes. $1 to $2 is 100%, $9 to $10 is only 10. So we always want to make sure a logarithmic graph is what's being used when measuring lengths of moves. So what we do here is we measure from the bottom of the candle to the top of the candle, and what we then do is we duplicate that line to the point that the stock breaks out from. You can see this actually had a small whipsaw effect here. If you look at that, you'll see that the stock actually in fact rallied from 344 to a high of $7.80. So very substantial. What then happened is we actually got a second flag. So again, substantial move in the stock. We look at what was the horizontal level that it broke. The horizontal level in this case was not down here. It actually gapped that. The horizontal level it broke was here. And so now again, we actually get our flagpole. We're able to duplicate it to the point at which it breaks out from, which is here. Again, we get our downward consolidation. There's the point it breaks out from. We measure where it is yet to rally to, and you'll notice that that's bang on, pretty much exactly where it went to. So these can be very effective traders, especially in flat months, because of the amount of movement in these systems, and they're ranked one of the highest performing strategies. I'll show you a couple of others. Here's another example of a flag, Fannie Mae. Yes, so basically Fannie Mae, if you have a look here, we have an ascending triangle formation. Ascending triangle formation. We break out of that ascending triangle formation here. There was your opportunity to go long. Now there's no way I would have held on if I was going long here all the way up to $6. That's the one thing about a flag, is we don't know. It's hard to predict the first flagpole. It's actually quite easy to predict the second one, though. A lot more probable. So here we have again a dramatic move to the top, breaks outside the Bollingers, and we get the flag from here to here. Just zoom in for you. Flagpole from here to here, which is where we peaked and consolidated. And we look at our little pennant formation. Okay, we'll copy that flagpole. You can see we get a nice move. Oops, excuse me. A nice move there on the break from 459 to a high of 635. So there's a question, do we try to enter toward the end of the consolidation? Yes, so what we're looking for is we're looking for this the shape of the flag, as well as a combination of measured Fibonacci's and a couple of other indicators that we use for the timing. So to look, so we read this question, we pick the second flagpole, we watch for the consolidation, check volume, check Bollinger, and if all look good, we go long. Okay, so I'll come back to some of those questions. What I use for targets and things of that nature is I actually use purely use levels. We've got a bit of extra time today, so I'm going to go into that and show you how we then start to look at targets once we've found the pattern. But yes, essentially there, Namdi, we are looking for the key characteristics of a flagpole is a significant volume burst as we break a clear horizontal or trend line based resistance. We measure the flagpole to the point, from the point of that break to the peak of where it tops out. And then we need to assess the shape of the flag as it starts to consolidate. And then I generally enter at the point of that consolidation. So if we've been able to see that it's a pennant, then I'll just look at what the midline of that pennant is, and I won't necessarily wait for the very last day to buy it. I'll just put my order in to get it at some point in the middle. So that in case it has a dramatic break, we don't miss the move. Now I'm going to go into this in a little more detail. This is kind of gives you a basic introduction of the flag. Now there was a comment earlier about Goldman Sachs and so forth. So I thought I would talk about that for a moment. The reason why these patterns and so forth work so well work so well is because of the presence of algorithmic trading. Now, we all know what algorithmic trading's all about. Algorithmic trading is the high-frequency traders, the Goldman Sachs, J.P. Morgan, the big boys, Knight Capital, all those guys, right? That's what we're talking about. So let me just, I'm just going to bring up some, I'm just going to jump into my other kind of slides where I talk about this. Excuse me. All right. And is everyone familiar with this idea of the smart money or algorithmic trading? I mean, everyone's kind of heard about it before, but yeah, I mean, one of the key things is that, as I said, so 70 to 80% of the market makes their decisions this way. And that's what essentially makes these patterns work, is that they're able to control huge amounts of volume in the stock market. It's so much, they have so much control because they control the volume. And whoever controls the volume controls price. So how do you control volume to control price? To drive price where you want to buy at and drive it up to where you want to sell at? Well, you do it through this high frequency. And what I mean by that is, let's say that you have $100,000 and you buy and hold a stock. Then you represent $100,000 worth of volume. Now, let's say that I want to buy that same stock, but I only have $1,000. I buy that stock, but then 5 seconds later I sell it. How much do I represent now with my $1,000? I represent $2,000. And if I do that 100 times in that day, I represent $200,000 of volume. And if I'm also my connection to the stock exchange is so fast that not only can I do that, but I can get in and out before you even have a chance to execute your order. I can really whip things into shape quite quickly. Now, in order to act so many times in a day, then the decisions that are being made by these computers have to be rule-based, and that's why these patterns I'm talking about, such as flags, are so consistent, because it's basically rule-based trading behind them that pushes it to these levels. So when we start to get further into that, that's why technical trading's become so predominant. Whether it's right or wrong, and whether it's voodoo or not, is not the argument. It's whether it's happening and whether it's important to understand it. And the reason why we focus so much on patterns is because if that's how the big boys are playing, and if they're about, because that's where they're going to push it, then we figure that the most important thing to do is to figure out how they make their decisions and figure out what are some of the rules that indicate these early signs from occurring. So when you ask me how I set my targets on flags and how whether I use trailing stops and things, everything that I trade, every single pattern or stock that I trade comes back to a key belief that I have about the market. I believe the market is not chaotic. I believe the market is organized chaos, and that a stock is simply bouncing around almost like a ping pong ball between and will not change direction unless it hits one of the decision points of these algorithms, one of the checkpoints, which is a horizontal resistance, a trend line resistance, or a moving average. So the argument that I make is that no matter what pattern you're trading, algorithms, the ones that really matter, don't see this, don't see stock charts. They simply see levels. So you talk about the flash crash. You'll see that the flash crash of May 2010, market crashed all the way down to the exact same level that it actually come from before. So when you look at a chart, I almost think of it like a series of floors. Floors where these types of reversals are likely to occur or not occur. And the really key step in going through this type of analysis is finding where those strong levels are. The problem with trailing stops, you see, is that what happens is you get, I'll have to use the paint, just excuse me. The problem with trailing stops is if you have 4 key levels, let's say here, and your stock comes down, hits support, and starts rallying up. I found that, as I mentioned at the beginning, I'm a level trader. So if the stock hits this point, I believe that this stock will either be a profit and go to the next level, or it will be a loss. And I want to get out of it the second it breaks that level. As long as the stock, however, is still above my support, I don't want to mess with it. I want to let it do whatever it needs to do until it hits my target. The problem with a trailing stop is if you start putting stop losses inside the zone, it's kind of like putting your hand, getting your hand stuck in the drawer. It's going to go back and forth. If your stop loss is inside it, you're going to get whipsawed out. So what I'll do is, as a stock rallies, I'll increase it as the stock breaks through the level. And then when it gets to the next level, increase it again. So that's why we look at those smart money zones, because they're ultimately the key thing that drives a lot of the movement in the market. So we'll go back to the charts here. So playing devil's advocate, question from the audience, playing devil's advocate, is it possible to generate an algorithm to read these patterns, say flags, and trade automatically and mint money, sort of like continuous arbitrage? Well, that is what the big boys do. These are the algorithms that are whirring away in the market are out there detecting these patterns and then trading them on an ongoing basis. If you look at the 60 minutes video on this, they talked about the fact that some of these firms haven't had a single losing month in over, at the time of the interview, haven't lost a single losing month in over 16 months, just whirring away making money. And if you think about it, that makes sense, because if 95% of traders lose money, hopefully no one in this group, but the 95% of traders lose money, that means that somebody else is making it, right? It's not just going into thin air. When someone loses $10, someone else makes $10. And so the market is very heavily not in your favor. It's full of noise and full of confusion to trick you into making bad entries. And so what we do when we start to go into this patterns, getting into technical analysis and patterns, is we're trying to protect as much as we can against that by playing by their rules, by diffusing the emotions that often leads to those bad decisions, and focusing more on completely rule-based, measured decisions. So the question you're asking, is it possible to create an algorithm? Yes, it is. That's been the premise of our work for the last 7-8 years as Acorn, and the previous 5 years as an individual for myself. These companies were paying for privileged access to real-time traders, front running from the exchanges. Yeah, absolutely. And yeah, you're correctly. The trick seems to be to play by their rules and stay small, so as not to move prices. Yeah, the trick is, really is. I don't think that we are going to be able to beat the market makers in the sense of we're not going to be able to outsmart Goldman Sachs. That's not what we're trying to do. But what we are trying to do is realize that this is how they make their money. So if we can detect when their bots go to work, so to speak, we can tag along for a little bit of the journey. I'll show you one more pattern because we do have extra time today, and so hopefully everyone's did get their coffee beforehand. So I'll show you one more pattern. And this is I actually touched on this before. This is an extreme scan where with flags, that is a, now let me preface this. There are 3 core groups of patterns: oscillating patterns, momentum patterns, and breakout patterns. Now just like most of the market doesn't know how to short, most people don't know the difference in those 3 patterns, or at least know when to use them. And that's a big problem, because oscillating markets are as different to momentum markets as longs are to shorts. It's very difficult to make momentum strategies work well in an oscillating market and vice versa. So it's important to always have several kind of scans up your sleeve so that when markets are oscillating, you run your oscillating scans and so forth. So the flag scan is a breakout scan, a breakout strategy. It is the highest performing breakout strategy that I know, and it's the only breakout strategy I use other than descending and ascending triangles. Now the other strategy that I really like is trading the extremes. Now this is something I'll be using almost very predominantly along with flags over the next few months. And the idea once again comes back to the smart money. It comes back to the idea that stocks deal with levels. And if you look at this, this is a company called Acorn, trades up to $30 million a day. And if you have a look at what happens, on 30 million bucks a day, this stock falls down to 24.50 and shoots up to 28.50 in a matter of a week and a half. That's huge money. We're dealing with $100+ million of movement from going straight down to straight up. And look what happens at this exact same level a few months later. Hits 24.50 and in one day goes back up to the same price of $28 that it went to before. Anyone else notice another smart money level? Well, let's look at this. This goes from $31 to $26.50 and then turns on a dime and goes straight up to 32. So to my algorithm, for the rest of the year, it's watching this stock and waiting for this price to get hit again, because it's likely that if it's only happened once before, it'll probably happen at least once again. And you can see that it comes back here, and again, powerful move. Once again, powerful move. And if we go even further along, actually happens one more time, and again goes from 26.50 to 32. These are smart money, very, very, very powerful moves where stocks are being pushed from one level to another on incredible amounts of money. And what the most amazing thing is that they're going exactly to these levels that have been predetermined before. And just like the traffic lights going from green to red, these algorithms go from buy to sell in a heartbeat, and creating these huge levels of volatility. And they're predictable. What's the support level at 26.50? How do you determine that? Okay, so basically when we're determining smart money, what we're looking for is we're looking we're looking at charts that are looking for, you know, a extreme level of resistance. So if you bring up, for example, let me bring up AMD. So we look at AMD. If you were to look at AMD, a lot of people ask the question, what would you do with AMD today? Okay, what would you do with AMD today? Now, I would argue that the reason why most people ask that question is because most people aren't using scans. So most people are, you know, they have their list of stocks that they will trade, and therefore they're constantly going to be looking at those stocks and trying to figure out what the best trade on their favorite stock is next. Here's the problem with that. If there's about 150 different patterns, maybe more, 60 to 100 that are very common, but 150 recognized patterns out there that this stock could possibly be in. Let's just say it's 60 for keeping things simple. 60 different possible patterns that this stock could be in today. Now, if this is the only stock you're going to trade, in order to be an effective trader with consistent results, you better be really good at all 60 patterns in order to know how to time entries, exits, and stop losses, and know what the stock is doing. Now, I would say that's just as effective as a restaurant that serves 60 different entrees. You can do it. You can make money. I'm not saying you can't. I'm just saying that there is, the way that I personally prefer is to, when I look at this stock, assume that most of the time I'm not going to be interested in trading it. When I look at the stock, rather than wondering what should I do tomorrow, I'm going to be asking, where do I want to trade it? So if I was to look at this company, and I have been, I've actually got an, I'm looking to, for example, short this if it gets to 450. So just like the question on Aaron's, how do we find the 2650 mark? What I'm looking for is I'm looking for areas on the chart where a stock has rallied up fast and aggressively and has come to a very sharp top and plummeted straight back down. I'm not interested in something like that. I'm not interested in something that's maybe bounced around and hit it 4 times. Those are weak resistance zones. What I'm looking for is I'm looking for where just one time, ideally, just one time, the stock has rallied into an area and plummeted, because that indicates that some kind of event happened when it hit there that just forced the stock back down. So again, we're detecting that smart money, and that's how we find those resistance areas. So we've got about 10 minutes left. There's a couple of examples. So AMD, do we use oscillating patterns on AMD? I mean, AMD is currently, if I was to say it's in anything, it looks like it's in a descending, now, I mean, I've been around the markets long enough to at least see the to recognize all the other patterns. It just doesn't mean that I want to trade all the other patterns. That's the difference. So if if we see the if we look at AMD, we've got equal lows, lower highs. AMD looks like, to me, a descending triangle. So will it get up to my 450, 460 area where I'm interested in shorting it? Maybe not. Where else might I be interested? I could be interested in buying it down here and just going for a short little rally from $3 up to $3.30. Small little grabs, 10, 15%. So it's coming back to flags. The trick to flags is going into the understanding of that these things can often be making new highs, and this is where the because flags and the extremes, these two strategies I've talked about today, are 2 of 4 strategies that I trade, and these will be the 2 strategies that I will be predominantly focusing on for the next 3-4 months. Some of the other momentum strategies I use aren't so effective in May, June, July. I'm stubborn like that. I've tried to make them work for the last 3-4 years, just continuing to use them because they were so good in the months before. And I'm not going to be so arrogant this year. So these are very high performing though. The flag formations and extremes. That's why I focused on them today. Flags, of course, the much higher profitability. However, they have these extended moves. This is another one we actually picked out that came up on our scan a few weeks ago, VTNR. You can see that nice consolidation. And then you look at the extension of where it got to, and there it is. So smart money is part of every strategy we use. It's just a matter of whether we have to project the smart money using the functions of how we've seen these work, or whether we're looking at previous levels or a previous level. All right, so we've got about 8 minutes left. I'll tell you a little bit about. There's a lot of questions on these strategies. I guess the whole focus of scans. This is really our niche. Scanning makes life easy. Easier. Makes it a lot easier because obviously there's a lot of different things that I'll go into some more questions in a moment for you, David. You know, the focus of, I think, any business, whether it's brick and mortar or stock trading, is, are you being efficient? You know, if you write the same email 20 times a day, you should probably automate that or put it up on your website as a frequently asked question. You know, that's efficiency. And if you know what type of stock you're looking for, you should be able to develop scans to find that too. And so in the stock market, you know, in the 4-hour work week, it talks about, you know, who's the wealthier guy, the $100,000 a year guy working 60 hours, or the guy working 10 hours making 60,000. And I would argue it's the latter. So in the stock market, you know, the question becomes, you know, have we got are we being efficient? Are we working 6 hours a day to make 10% in a month, as one day trader told me the other day? Or are we happy to spend 5.5 hours less to make a little bit less as well? The idea about scanning is that it really helps us to get closer to the 30 to 40 minutes a day. You can obviously make a little bit more by watching it all day long, because things will pop up. You can leverage more. But if you're somebody that kind of values time and efficiency, scans either way are a very, very effective thing to add to your arsenal. So I've talked about 2 of the patterns that I really like to trade. What makes flags very effective, of course, is that it's one of the most reliable and profitable breakout patterns sought by professional traders. I've always known it was a high probability pattern. The problem has been finding them, and that's always the issue. Is you can have a great pattern, but if you don't know how to locate it, it's not going to do you much good. So that's if you are interested in going learning more, we do run a special boot camp on the 14th, which is all about this, showing you these scans that we've developed. The Finding Flags Bootcamp is next week on the 14th at 8 p.m. Eastern. So we talked about the basics of what a flag is and how to identify it. But the key thing that prevented me from really being very profitable with these in the past was that I just couldn't find them. And so what we spent quite a lot of time on, and we finally brought the product to a level of perfection we were happy with late last year, and released it in January. Actually, was our Flags Workshop and Flags Scan. So we've developed a scan that actually analyzes the entire market, every stock in the US and Canada. You can use it on worldwide markets as well. And what it will tell you is generally a list of about 6 or 7 stocks that are all meeting the flag criteria. So what we built into that scan is time frames. Like there's certain things that have happened within a certain amount of time, certain volume levels, certain detections of money, smart money, to make sure that the smart money is accumulating stock as the flag rallies instead of selling off into it. So there's a whole list of about, I think, 7 or 8 things that are and different time frames that are all built in. So it's fairly complex algorithm, and it will tell you exactly what stocks are meeting that criteria each night. You'll get about 7 to 8 stocks. So we'll be showing you how to set up that scan. And more importantly, even whether you use the scan or not, I would recommend you do. It saves you a ton of time. But it's also then the levels. So I'll be going through and showing you exactly how to measure where the entry point would be that we would for an aggressive entry, a conservative entry. And now, of course, it's up to you where you decide to enter and exit, but this will show you where our strategy would dictate the ideal possible entry point would be on that flag. So once you see the flagpole, how to predetermine where that point will be so you don't miss the second breakout. Of course, how to measure the flag to know whether it's a downward channel or a pennant, because that will affect your entry. How to consider setting your stop losses, what type of risk reward is possible. And then what we do is we give you two versions of the strategy. The same scan, exact same scan, but two versions of the strategy. One is for the aggressive target, where we're expecting, quite often it's 30, 40, sometimes 50% moves. Those are the aggressive targets, some of what we've talked about today, FNMA, VTNR, BIOF, PTX is another one. But also how to set conservative targets. So if you're somebody that maybe favors higher probability over high profitability, we also teach a second version of the strategy, which is higher probability, but more targets kind of those 10, 15, 20% moves. I'll have a quick look at the questions here. We've got about 30 seconds left. If there's any questions on this, is the class recorded? Absolutely. In fact, anyone who's this is actually the pre-release of our Flags Bootcamp. It's a special launch. We're actually the full version of the course is actually much more expensive, and we're launching that next month. So anyone who's a member of this workshop next week will actually be able to re-attend this workshop on any future dates as part of your benefits. So we look forward to hopefully seeing you all there. I can see we're coming to the end of the time, so thanks so much everyone for all the questions. And if you do have any questions, just send them in to info@acornwealthcorp.com, or you can call us and we'll be happy to answer any questions by myself or my staff throughout the day today. Thank you so much.